Today in Trader Tip Tuesday, I have a special excerpt for you. We have a challenge. It's called the Red Pill Challenge. And the Red Pill Challenge is amazing if you're new to options and you really want to understand them. And today we're going to share with you a clip from our Red Pill Challenge that we're going to talk about how and why do I want to use options. This is a big push of ours, is to really help you understand how much options really would help you to trade better, help you to manage your risk better, help you to trade far more efficiently with less capital and have a greater return on capital when you do well, and to make your life easier, to not have to work so hard, to not have to have such an eye on the position, because when you get into the right option position, it will just take care of itself. So check out this clip, and I will see you next week. Just remember, we're always trying to help you take your performance to elite level. In my view, you cannot be elite without using options. So check out the clip. I'll see you next week. So why do I want to use options? Well, options are going to open up new dimensions to your trading. So one of the things I want you to understand is that when you trade options, you can benefit from four major factors: direction, volatility, time, and movement. Without options, you're trading direction. That's it. With options, you introduce new factors that you can profit from in addition to direction. So when you trade direction, you benefit from a single profit factor, which is direction. It's also called deltas in the options world. There's two reasons why options can outperform a standard underlying trade. One is you have the ability to profit from multiple profit factors in the same idea. So an example would be you can create a trade that benefits from both direction and movement, or direction and time. The second is options give you leverage. So they give you the ability to use multiple options to control your idea with the same exposure and the same risk as an underlying. So the example could be here, you could control 4 options, which ultimately would represent controlling 400 shares of stock, and do it with the same exposure and the same risk as controlling 100 shares of stock in a directional trade. So basically, if the trade works, you're going to be right on 4 times as much using options than you would be being long just underlying, being long just a stock. So when we trade underlying, and underlying is stock, futures, foreign exchange, cryptocurrency, whatever the product is that we're trading. When we trade underlying, we benefit and we lose on direction. So we might have a profit target, we have an entry location, and we have a stop loss. And basically the path to the target and the path to stop loss is 1 to 1. You're going to make it the same rate going up as you lose going down. When we take a trade and we use options, we benefit from the 4 profit factors: direction, volatility, time, and movement. We also can lose on these 4 factors of direction, volatility, time, and movement. But we can create trades, for example, being long a call option, that if we're right on the long call, we can make not only on direction, but also on movement and volatility. Where on the downside, we can lose on direction, time, and volatility. But the one thing you're going to notice is that the diagram is different because the call option has an asymmetric payoff. Directionally, we make 1 to 1 versus what our risk is. We make 1 to 1, we lose 1 to 1. In options, when we make, our wins are going to accelerate and our losses are going to decelerate. Our losses are going to be a limited risk, and our wins are going to be unlimited gain. So it creates a power within the structure. Now, why do I want to use options? Once we understand what's possible with options, we can set out to determine how we should use options to meet our objectives. So we have another class that we teach that we call the 5 pillars of wealth. And in there, we talk about how you build a financial foundation that makes you infinitely wealthy. We define infinite wealth as anything that you do that takes less than 2 hours per week, that generates an income that is greater than your monthly expenses. So if you have an activity that you can spend less than 2 hours a week and make enough money that covers all of your monthly expenses, you're infinitely wealthy. That basically means that you work less than 2 hours a week and you never have to work again outside of that. All right. To do that, we need 2 types of strategies. We need to create cash flow, and we need to create capital appreciation. Cash flow and capital appreciation. Options help us with both strategies. Okay. So cash flow is investing for yield. We're going to talk about this more in a minute. Appreciation is trading, where you create large influxes of capital versus one-time payments. Understanding options will allow you to capitalize on the opportunities in both categories. Both. So in this lecture today, in this lesson, we're going way beyond just trading a strategy. We are introducing a mindset that is very powerful. So let's talk about this. So we're going to talk about investing versus trading and how I think about this. So as we look at our portfolio, it's helpful for us to think about what is an investment and what is a trade. So let's get clear about our definitions. As I said, our goal is to build enough passive income so that our expenses are covered, so we're infinitely wealthy. Now, appreciation from trading creates large influxes of capital that creates a war chest of capital. This war chest of capital is to be used in an opportunistic way to build further cash flow and also to create further large winning trades that add to the war chest. Now take a break for a second here. So when I was 14 years old, my dad sat me down and he had a talk with me, and he said, son, if you ever want to get wealthy in your life, you have to figure out how you're going to be involved in something that gives you big hits of cash. Because you need to understand you're never going to become rich on a salary. You're never going to become wealthy on a salary. And the reason for this is that because you're always going to spend whatever it is you make. You have to be incredibly disciplined to save with a salary. And this happens in subtle ways. You make $40,000 and you say, well, I can't really save any money because I don't make much. If I start making more money, then I'll start saving. So you get a raise from 40 to 50,000. And just when that happens, your car breaks down. So you're like, well, I need to get a new car. So I'm going to spend a little bit more money to get a new car. And then you live in an apartment, and then you get a raise and you're like, well, I'd like to get a nicer apartment or maybe buy a condo. So I'm going to work to try and get into a condo. And then what happens is basically you got a raise and you spend it on a car, and you got a raise and you spend it on a condo, and you got a raise and you spend it on a vacation that you knew you deserved because you haven't gone on vacation for 3 years. And then you got a raise and you spend it on getting married. And then you got a raise and you spend it on having kids. And then you got a raise and you spend it on putting your kids in a private school and paying for their college. And it just grows. Your lifestyle will always grow to whatever the level of your monthly income coming in is from your job. So the reason my dad said this is when you get big hits of cash, you instantly have savings, or you can instantly pay down debt. You can reduce the cost of your lifestyle, or you can raise your investable assets that help you get ahead. So you have a certain amount of money coming every month, and then bam, there's $50,000. You live on the amount of money you have coming in, and bam, there's $100,000. And this is how you get wealthy. So this is such a different mindset than most people. And we really want to step in and embrace this because this has big ramifications for your future. Now that I've said that, let's talk about investing versus trading. So first of all, increasing our cash flow is not a consistent endeavor. It is an opportunistic endeavor. I'm going to show you some numbers today that you're going to go, bullshit, not possible. And I will tell you, they're not possible day in and day out, but they are possible in the right place at the right time. This is what we need to understand. So going back to our infinite wealth analogy, we get enough money coming in. Let's just say we live a very simple lifestyle. We can live on $5,000 a month. We get $5,000 of passive cash flow coming in. We're infinitely wealthy. But that's not the end of the game. What we want to do from there is we want to raise our level of infinite wealth. That's how we raise our lifestyle. We don't raise our lifestyle when we get a big hit of cash. We raise our lifestyle when our passive income goes up. If we can get us from 5,000 to 10,000, we can live a life that's twice as good without working. If we can get 10,000 to 20,000, 20 to 50, 50 to 100, and it's coming in month after month after month, you're going to get to a place that you can safely live in a big house, drive a nice car, go on great vacations, and know you're okay because next month there's more coming without you working. Then you get to take the best of you and use it to raise the lifestyle. Okay? Now, to go from 5,000 a month to 10,000 a month, we need to increase our cash flow. But that doesn't walk in the door every day. And one of the things we want to understand, whether it's traders get themselves in trouble thinking they need to make a certain amount of money every day, or they need to acquire cash flow consistently. That's not how it works. That's what leads to bad decisions that bite you in the ass later. So we need to understand it is opportunistic. So we build this war chest of capital, this war chest of cash, and we wait. We wait for the right times and the right setups, and we put it to work. When these opportunities come along, you need to have the cash on hand to take advantage. We love entering investments with long-term cash flow characteristics if we can get a really good, solid rate of return. And the problem is everybody thinks, I need to have my money working. I'm willing to take a much lower rate of return today and be ready for the moment it comes along when I can nail it. Because I will get that loss of return back in spades over the years that follow if I do it at the right time in the right place. So let's talk about what is an investment. So I'm going to share a story with you. In 2008, when the stock market was really falling apart, credit was falling apart, I knew stocks were getting really cheap. And I was also looking at corporate bonds and municipal bonds, specifically closed-end bond funds. And they were getting insane too. And so I started putting together a plan and identifying a list of assets that I was going to buy that I knew were cheap. I came up with a list of dividend-paying stocks. Every stock on the list paid at least a 10% dividend. And then I had a list of bond funds, and the bond funds paid anywhere from 15 to 40% a year in return. Bond funds. Okay. So I knew that both of these would be excellent investments. So I went to two of my partners and I said, I'm going to put this portfolio on. You guys want to go in on this with me? And they're like, yeah, sure. It sounds cool. Go ahead. So they put up some money. I had money. So in we go. I go in and I start putting on the portfolio of stocks and the bond funds. Put them on. This was in January of 2009. I'm putting these trades on and the first week, as soon as I buy them, they just keep falling. It's free fall. I'm down $2 million on them the first week. And my partner's like, dude, what's going on? Are we okay? Like, what's your plan with this? And I'm supposed to be known as the guy that's great at trading plans. I always got a plan. I always know what I'm doing. And I'm kind of like, let me get back to you on that one. And so I went back and I was thinking about it. I'm like, I know these are good, but I have to think of them differently. Like, what am I missing in my thinking? Because if it's a trade, I need to get the hell out of it. I can't just buy something, have open-ended risk and hope it works out. That's not how it works. And I knew that. But I'm like, I know this is different. So what is different about it? And it hit me. Every one of these I was doing for the yield. I was not doing it at the price that I was buying them at. I was doing it because of the yield. So I want you to think about, let's say you went out and bought an apartment building for $1 million. And let's just say that apartment building was kicking off, it was generating $200,000 a year in net income. So it's returning 20% on the cost of the building. You wouldn't go out every week and order an appraisal and go, what's my apartment building worth? And then if the appraisal came back and it's now worth 750,000, not $1 million, you'd be like, oh, I'm down 250 grand on this apartment building. Stupid. This isn't what you do. You're like, I'm fine. I'm getting 200 grand a year in income. If I wait this out, I'm going to raise my rents and I'm absolutely going to kick ass on this. I don't care that it went down 250,000 in fictional value. I care that I put $1 million in and I get 200 grand this year and 200 grand next year and 200 grand the next year. You follow me? Everybody follow me? Okay. So what it hit me is an investment is something that pays you a consistent return. It's something that gives you cash flow. So the objective is not the price to go up. It's great if it goes up. The objective is the rate of return. So the profit is realized from regular income, irrespective of its market value. So these are examples of things that you could invest in that would qualify as an investment, that would give you the cash flow that we're talking about. Bonds and corporate bonds, tax liens, real estate, businesses, royalties, dividend paying stocks, and option strategies. Okay, so that helped me reframe this.